Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. So today our group will present to you the topic of tax planning for companies. I will start with the commencement of the business. The determination of business, commencement date of business is difficult as it requires consideration of all circumstances and fact of each case. It is crucial for such determination because the revenue expenses incurred prior to the commencement of the business is not allowed as a deduction. Alright, once the company has commenced, the company may obtain tax deduction for revenue expenses incurred. Well, if the company has not generated any income, then the business loss can be set off against the other income in the current year or can be carried forward to the future years. However, the qualifying expenditure incurred prior to the commencement of date of the business is deemed incurred on the date of commencement. For tax purpose, commencement of essential activity is relevant to determine the commencement of the business. We should take note that the commencement of date of business is referenced by the activity of the company, not the income generation. Okay, how can we know that the business or the company has commenced its business? For example, for trading company, it said that commencement business of trading company when it embarks on the purchase activity, which is the essential activity of the trading business. There need not be any sales in order to commence business. For the manufacturer company, it's said to have commence business when it embarks on its production of manufactured goods. For hotel, it embarks when it's open the door to the public. In other words, soft launch.
Next, I will pass to my friend.
Hello. Okay, thank you Hafiz for the nice presentation. So as for today, I would like to present to you about the financing arrangement. So why financing arrangement is important to the company? So financing arrangement is important to the company because it would affect the cash flow of the company, and also it would affect the tax payable of the year assessment for the company. As for the financing method, there are 4 financing methods. The first one is wholly cash. The second one is through term loan or overdraft. The third one is by hire purchase, and the final one is by leasing. So basically, how we want to claim the capital allowance on the asset that we acquire from the financing arrangement. So the capital allowance will be given to the acquisition of asset that fall into a group of plant, machinery, or industrial building. For the claim of capital allowance will be given to the asset, acquired asset of the company which they have incurred, owned, and used the qualifying capital asset in the business. So for there are 2 types of asset that will given the capital allowance, which are qualifying asset for the industrial building. So there are 2 types of allowance, which are initial allowance and annual allowance. For the qualifying asset industrial building, the initial allowance will be given is 10%, and the annual allowance will be given 10% to 20%. For the next type of asset, which are qualifying asset for the others, the initial allowance will be given is 20%, and the annual allowance that will be given to the asset for others is 10 to 20%. So there are also accelerate capital allowance. There are many types of accelerate capital allowance that you can refer in the textbook. So if any of the asset there will be initial allowance and also annual allowance will be given to the much type of the asset that have been listed in the textbooks. Okay, next I will present about the year of assessment 2000, which is current, and the subsequent years. So the capital allowance has been categorized into 3 pools. So the 3 types of asset is office equipment, furniture and fitting, plant and machinery, and the third one is heavy machine and motor vehicle. So for the initial allowance of office equipment, furniture and fitting, it will be 20%, and the annual allowance for office equipment, furniture and fitting, it will be 10%. And as for initial allowance for plant and machinery, and also heavy machine and motor vehicle, it will be 20%, and the annual allowance for plant and machinery, it will be 14%, and the annual allowance for heavy machine and motor vehicle, it will be 20%. So next, the manner of set off of the capital allowance. So how we set off the capital allowance? So basically, capital allowance will be set off against the statutory income of the business itself. So any unabsorbed capital allowance can be carried forward into the next year and will be set off with the statutory business income of its business. So, okay, lastly, I will present about the alternative of acquisition of the asset. So basically, I will explain to you about two type of acquisition of asset, and my friend will be explain more. So the first one is acquisition by cash. So basically, the capital allowance claim will be based on the full cost of the qualifying asset, except passenger vehicle are restricted to 50,000 ringgit or 100 ringgit. And for the first year, the company may claim the initial allowance and the initial allowance based on the full cost of the qualifying asset and annual allowance also. And for the subsequent years, the company only can claim the annual allowance. Same goes to the acquisition of asset also. The method used or the requirement needed for these two types will be the same. Next, I will pass to my friend Najwa.
Thank you, Khadijah. So we will proceed to the next point is acquisition through hire purchase. In this case, capital allowance will be claimed based on installment paid, and it's not the qualifying expenditure of the asset. The initial allowance will be given for each new installment paid, which is during the year. And for the annual allowance will be computed based on the accumulated installment paid, which is based on capital portion. The hire purchase interest is recognized as revenue expenses and will be given deduction to the adjusted income of the company. So the next point is acquisition through leasing. For this part, the company are not entitled to claim the capital allowance, but the company is entitled to claim full leasing amount, which is subjected to passenger vehicle, which is restricted to 50,000 to 100,000 ringgit. So, it will be recognized as revenue expenditure. And for the tax purposes, the lease rental will be more advantageous because of the timing of the set off, and the last is because of the utilization. So basically the claim of the revenue expenses will be more clear in result in deduction compared to the claim of a capital allowance. So for more detail about the more advantages of the lease rental, you can see you can go to the textbook for the more details. Okay, that's all for me. I will be passed to the next to my friends.
So next is the disposal of assets. Okay, in disposing asset, the company must at least acquire the asset for within 2 years. For 2 years. So if the company disposes asset within the 2 years of acquisition, the tax authority may empower to claw back the capital allowance claim in the previous year and charge it as balancing charge in the year of disposal. So it is important for the company to acquire the asset at least for 2 years. Next, in disposing the asset, the company must consider two main factors, which is the residual value and residual expenditure and also the sales proceed. So, if the residual expenditure exceed the sales proceed, the company may obtain balancing allowance. Therefore, the company must dispose the asset in the year end instead of the following year, so that they can obtain the balancing allowance and in order to shelter the adjusted income. But if the residual expenditure is less than the sales proceed, the company will obtain a balancing charge. So, the company must consider to dispose the asset in the following year instead of the financial year end, because this is in order to defer tax liability. So, next, control transfer. So, control transfer provision is established to prevent related party claiming excessive capital allowance through non-arm's length sale. So this act apply when the person has more than one business sources and want to transfer the qualifying asset from one business sources to another business source. So the person is said to have a control when he owns more than 50% shares of the company or exercise a significant influence in the conduct of the company. So the tax implication is the asset is deemed to have been transferred at the tax written down value, which is the residual expenditure of the transferor. So no balancing charge or balancing allowance can be claimed would be arise on the transferor, but the transferee is entitled to claim annual allowance based on the original acquisition price, but restricted to the residual value of the asset transferred. Okay, therefore, the taxpayer is actually benefit the disposer but not the acquirer.
We're going to move on to distinction between business income and investment income. As for the Act, provided that there are more incentives for business income rather than investment income. The examples of the advantages are that business income can utilize the unabsorbed business sources of the company, even though they have different sources of income. Next, there is availability of capital allowances. They also have the availability of current year loss. Furthermore, they have the carry forward of unabsorbed loss, and lastly, the flexible deductible of expenses. Alright, now we're going to move on to capital allowances. What are capital allowances? Based on Section 4A, the Act has stated that there are charges on tax income in respect of profit and gains from a business that suggests that each of the business is a separate income. Right. Capital allowances is available to reduce adjusted income arising from a source of existing of a business. However, capital allowances are limited to the value of the business income itself. And if there were unabsorbed capital allowances, it is only available against subsequent income for the same income itself. And there is also no provision allowed for the deduction of taxable income from other business sources. Once the business has been seized, the unabsorbed capital allowances would be a permanent loss. For an example, only the same manufacturing source can be set off against unabsorbed capital allowances from the same manufacturing income. Right. Now we're going to move on to tax planning. For a company to fully utilize its capital allowances, it is said to be most efficient for the company to structure their various business activities to be one business income rather than two or more. Next, the ability of the new venture to supplement closely the existing business would have said to be incidental to the main trade. The factors that determine that the new venture is closely supplements the existing business depends on whether the new business of the new venture is using existing plant and machinery, existing workers, existing facilities, or closely connected to inseparable from each other. If these factors existed, the business is said to be one of the same source as the existing business. The profitability of the new business then may be able to utilize two things. The first one is unabsorbed capital allowances of the existing business, and the second one is unabsorbed business loss from any businesses. Right, we're going to move to a smaller topic, management services. Alright, this provision for management services are entirely a separate business services sources. To establish the business intent, the provision needs to be supported by two things: a management service agreement entered between two parties. The basis of charging needs to be stated in a detail by reference to the nature of services they provided, and the agreement need to be stamped under the Stamp Act 1949. That's all from me. We're going to move on to the next presenter.
Alright, before this, we already elaborate about the business income, balancing charge, and capital allowance. What happened if the company incurred the business loss? When the company incurred the loss, alright, under the business loss, there are three consequences, which is the first one is adjusted business loss, which is the adjusted business loss is the current year business loss. Second one is group relief loss, and the third one is unabsorbed business loss. Alright, for the adjusted loss, for the current year adjusted business loss, the loss is only allowed with the regard to business source. And the second point is adjusted loss is deducted with the statutory aggregate income. I'm sorry, not statutory but the aggregate income. Okay, what happened if the company incurred the loss for the business? When the company have two kind of business, which is both of the business incurred the loss, the company must accumulate the loss, and the loss adjusted loss will be deducted against the aggregate income. Alright, the second one is group relief loss. When the company have when the company is a parent company, subsidiary company, the parent company can enjoy the 70% of current year business loss of a company can be surrendered on its related companies, claimant company within the group. But the company needs to fulfill the condition. The first condition is must be a tax resident and be within the group for the past 12 months. The second condition is each company's paid-up capital is more than 2.5 million at the beginning of the year assessment. But the company must not enjoy the incentive such as pioneer status or investment tax allowance. Second one is Malaysian ship exemption. Third one is income tax exemption. Fourth is reinvestment allowance. And the last one is they cannot enjoy the revenue deduction on approved foods production, cost of acquisition, and the last one is proprietary rights. Alright, the last one is unabsorbed business loss. Alright, section 44 subsection 5 permits that the current year business loss which cannot be fully deducted in the current year carried forward to future of assessment. Unabsorbed business loss is accumulated as one balance, which is when the company incurred the loss for the first year, second year, and the third year, the loss will be accumulated to be a one number. And the third point is under unabsorbed business loss, only allowed to be deducted from the aggregate statutory income from business. Alright, as a conclusion under business loss, as a tax planning measure, consideration should be given to utilize the unabsorbed tax losses by the injections of profitability activities, business source into such company.
Okay, the next point is investment income. A company would derive investment income in the form of interest, dividend, or rental. Each of these sources constitute a separate and distinct source of income. They have three characteristics of investment income which is commonly used. The first one is investment income cannot have current year losses. Investment loss from one source is not allowed to be set off against other income in the same year. So investment losses is considered as permanent loss. The second characteristic is the deductibility of interest is subject to wholly and exclusively tax. And it is should the expenses exceed income in any year. The excess will be permanent loss. And the last one is each sources of income would not be further divided according to usage. For example, for rental, income producing or non-income producing or non-income producing sources. For example, for interest. And the next is I will explain about interest restriction. According to section 33 subsection 2 of ITA, specifically provided that where a taxpayer has borrowed for the purpose of producing business income, the deductibility of the interest paid on borrowed money would be restricted based on formula. The amount of interest restricted equal to investment divided by borrowing time interest expenses. So the application for the formula is where the total cost of investment and losses and loan which are financed directly or indirectly must not exceed 500,000 ringgit. Subsection 33 subsection 2 also state that interest restriction will be computed based on end of year balance. They have a few conditions. If the amount of investment is equal or more than borrowing amount, the whole amount of interest is not deductible. However, if the investment amount is lower than borrowing, then the portion of the interest will be deducted. The amount of interest restricted will be added back to arrive business aggregate income and would be allocated to individual investment sources. And the next is if the restricted interest cannot be offset. Okay, if the restricted interest cannot be offset against the income of the related investment, the excess interest expenses cannot be carried forward and it would be permanent loss. The next is tax planning. They have 7 considerations to take into to overcome this problem. The first one is identification of investment or advance funded from existing borrowing and direct allocation of the cost of borrowing to the investment or advances. Second is reviewed interest charges annually. And the third is arrange for the subsidiary or associate company to borrow directly from the bank. The next is establish separate bank account to hold specific loan monies exclusively for business use. And the fifth is create sufficient non-business income to absorb interest applicable to investment. And the second last is disposal of investment that are not profitable to pay off the borrowing with higher cost of fund. And the last one is withdrawal of fixed deposit
to settle the borrowing. That's all for me. I will pass to the last presenter.
Okay, I will present on the last subtopic, which is investment in company. There are two category investment. The first one is share capital, which is equity, and the second one is debt financing. Okay, the return on investment for share capital is in the form of dividend, but for debt financing, the return of investment is in the form of interest income. Okay, for share capital, company should able to pay exempt dividend from the exempt account and single tier dividend account. Okay, with the effect from 1st January 2014, all exempt dividend received are exempt dividend. Okay, for debt financing, investor will receive the full amount of interest income from the investee company, and quantum of interest income received is normally higher than the dividend. Okay, next is the interest restriction. Okay, for Malaysian taxation is based on sources by source basis. If an investor borrow externally and in the form of share, the interest expense is only available to be set off against the dividend income from the investing company. As dividend received is exempt under single tier dividend system, then the unabsorbed interest expenses would be a permanent loss to the investor. Okay, for debt financing, the investor company will be charged a required amount of the interest income to set off the interest expenses suffered, but must ensure the full deductibility of interest expenses. Okay, next is investor company is qualified for a tax exemption in its account so long it has utilized the loan in the production of the income of that sources. And lastly is must ensure minimum interest restriction loss. Okay, and lastly is the withdrawal of investment. Okay, for share capital, we are not allowed to be taken out, but if the company carries out the capital reduction scheme, they can withdraw the investment. Okay, in Malaysian Companies Act, they state that the company not permitted to acquire its own share. However, in 1997, they allow listed company to buy back its share under certain circumstances. Okay, and for debt financing, we are allowed to withdraw the investment at any time without any legal constraints. Okay, that's all.
That's all from us.
Thank you.